All right, today we're going to tackle one of the most powerful and honestly most controversial ideas in all of finance. It's a theory that really challenges the whole game of stock picking. It's called the efficient market hypothesis, and it all boils down to one huge question that every single investor has to ask themselves. And here's that question. Can you actually beat the market? I mean, can you, through your own skill or deep research or even just a gut feeling, consistently pick stocks that outperform everybody else? It kind of feels like you should be able to, right? Well, finance theory has a pretty surprising answer to that. So, let's dive right in. The efficient market hypothesis, or EMH for short, is basically the academic world's big idea about how information and stock prices really work together. And let me tell you, its conclusion, it changes how you see everything. So here's the absolute core of it. EMH says that at any given moment, a stock's price already reflects every single piece of available information about that company. The good news, the bad news, public announcements, analyst reports, it's all baked right into the price you see on the screen. And if that's true, well, there are no undervalued stocks to find because everything is already priced perfectly. Now, this isn't some new idea. It was really hammered out by the economist Eugene Fama way back in 1970. He took a bunch of earlier concepts and structured them into this powerful theory that, is still debated and taught in business schools all over the world. The logic behind it is actually pretty simple to grasp. Just imagine a company releases a fantastic earnings report. Well, millions of investors all around the world see that news at the exact same time, and they all rush to buy the stock. All that demand, boom, it instantly drives the price up to a new level that reflects that good news. The chance you had to profit from it, it vanished in seconds. But here's where it gets interesting. This idea isn't just a one-size-fits-all thing. Fama was smart, and he broke the theory down into 3 different levels, or forms, and each one represents a deeper, more intense level of market efficiency. So here's the quick and dirty breakdown. You've got weak form, which says past prices won't help you. Then there's semi-strong form, where all public news is already priced in. And finally, the most extreme version, strong form, where literally nothing can give you an edge. Okay, let's break down that first level. Weak form efficiency. This says that all historical data, every past price squiggle, every trading volume bar, is already reflected in the current price. And this is a direct shot at the whole idea of technical analysis. It basically means that staring at charts trying to find patterns is a waste of time, because any pattern you think you see is just random noise. Now, taking it a step further is the semi-strong form. This version is even bolder. It claims prices reflect not just past data, but all publicly available information. We're talking earnings reports, news articles, economic forecasts, the whole shebang. And the implication here is absolutely huge. It means even if you're a genius at fundamental analysis, reading every financial statement, you can't consistently win. Why? Because that brilliant insight you just found is already in the stock's price. And finally, you have the most extreme kind of out there version, strong form efficiency. This one argues that prices reflect all information, period, both public and private. This means that even a CEO who knows about a secret merger before anyone else can't profit from it because somehow the market already knows. Now, let's be real. Most people agree this form doesn't actually hold up in reality. I mean, insider trading is illegal for a reason, right? But it represents the absolute theoretical limit of the idea. Okay, so that's the theory. But let's get practical. Why should any of this actually matter to you? Well, the implications are profound, and they lead straight into one of the biggest, longest-running debates in the entire world of investing. And this brings us to the big showdown: active versus passive investing. See, if you believe the market is efficient, then the whole idea of active investing, paying a manager a ton of money and fees to pick stocks for you, starts to look, well, a little questionable. The logical conclusion of EMH is that the smarter path is passive investing. Just buy a low-cost indexed fund that simply tries to match the market, not beat it. And there's another angle here too. For corporate managers, the people actually running the companies, EMH is useful because it suggests their company's stock price is a fair and accurate report card on how they're doing. They can basically trust that the market is valuing their decisions correctly. But, and this is a really, really big but, there's a problem with all of this. This entire theory is built on the idea that markets and all the people in them are perfectly rational, that we're all just cold, hard calculators of information. And we all know that's not quite how people work, is it? Which gets to the heart of the critique. This theory is so elegant, it's so clean, but does it actually match the messy reality we live in? Are markets really these perfect information processing machines every single second of every single day? Probably not. And this is exactly where the field of behavioral economics jumps in. It reminds us that investors are, well, they're human. We're driven by fear and by greed and a whole list of biases. We overreact to scary news. We follow the herd right into crazy speculative bubbles. And then we panic and sell at the worst possible time during crashes. Our irrationality can seriously distort prices. I mean, if you need a poster child for this, look no further than the 2008 financial crisis. For years, this wave of insane optimism created a massive housing bubble. Prices were clearly not reflecting their true value. The market wasn't efficient, it was emotional, it was irrational, and it eventually crashed in the most spectacular way. Okay, so if the theory has this massive hole in it, this human-sized hole, why are we even still talking about it? Because, and this is important, even if it isn't a perfect description of reality, the efficient market hypothesis still gives us a crucial baseline for how we should think about markets. The theory really gives us this incredibly powerful and, frankly, humbling piece of wisdom. For the vast majority of us, trying to outsmart the combined intelligence of millions of people all over the world, it's a losing game. The default assumption should always be that the market, as a whole, is probably smarter than you are. And this core idea leads directly to another famous theory called the random walk. Think about it. If all the information we have today is already in the price, then the only thing that can move the price tomorrow is new, unpredictable information. And because that news is unpredictable, future stock movements are, by definition, random. So, in the end, EMH is still a cornerstone of finance because it gives us a benchmark, an ideal to measure against. You can think of it like this. EMH is the perfectly rational ideal, while behavioral finance describes the messy reality. The truth for most investors lies in understanding both. EMH forces us to be humble and focus on what we can actually control, like our long-term goals and diversification, instead of chasing short-term gains that are basically unpredictable. Which leaves us with this final, fascinating puzzle to think about. We know markets aren't perfectly efficient, so there must be opportunities out there, but we also know they are very, very hard to find over and over again. So for any investor who does manage to win big, how much of that success is really true skill, and how much of it is just being on the right side of a random walk? That's the billion-dollar question, isn't it?